Well, in 2 days, the Federal Reserve does their usual, cut rates and pretend to tell us that they know what the hell they're talking about. And in this video, we got to break down why the next 6 weeks are so much more critical than the last 8 weeks that we've had, and why it means everything for the state of the economy. Look, the last 8 weeks, we pretty much haven't had any catalysts or basically reports from the government to tell us how things are kind of going on now. Even though we believe a lot of these reports are rigged and inaccurate, at least it's something to go on. Things have been pretty dang quiet. We had government shutdown, we didn't really have catalysts that showed up because they either got canceled or delayed, and they're all delayed to, well, now basically the future, what we get to look forward to. And so we're really running on fumes in terms of data. And after all, the Federal Reserve is supposed to be
data dependent.
And so that's why it's not a surprise that right now markets are a little on edge. Today, you've got this rejection at 627 on the Qs. You got a little bit of a bleed over on the Qs. Tesla got a downgrade, so you got a bit of a bleed on Tesla. MP Materials kind of keeps dropping off those all-time highs that we FOMO'd up to under the Trump administration's investment into the company. You know, Tesla's almost back here at 433, still knocking on the door of all-time highs, but you know, intraday it's been bleeding a little bit. It's down almost 4%. So what's going on? It's all Fed nervousness, but not just that. We got to know the conditions for what could actually mean that we could turn this money printer on and start really getting back to a real bull run, kind of like maybe Canada's trying to pull off. So let's talk about this. First, mark your calendar for the following dates. These are really important. We've got the Fed meeting and the Employment Cost Index coming out on Wednesday. That's December 10th. Then we have the inflation report coming out on December 16th, followed by the November jobs report on December 18th. That's already a lot. So we get to know, are we getting inflation from stuff and from wages? The answer is probably not yet, though we're still worried we might see some tariff inflation coming up. The Fed basically wants to cut. The only reason they would be hawkish is this fear that this tariff inflation is going to come and prop up inflation, which unfortunately increases the odds of them making a mistake if the economy is about to roll off a cliff. Then we got caddies coming up Jan 9th, Jan 13th, and Jan 14th. In order, jobs, CPI, PPI. So basically, well, for the last 8 weeks, we've pretty much had no data. In the next 5, we're about to get a crap load of data. And what we're looking for is, are we about to fall off the cliff to where the money printer is about to get yeeted on? And there's a pretty real consensus, T.S. Lombard agrees, that if layoffs hit, then we are going to run the money printer like never before. Now, people argue like, but Kevin, how can they possibly run the money printer? Debt is at all-time highs. And that's always where I like to say, that's the noob argument. The noob argument is, but Kevin, debt is so high. How could they run the money printer when there's so much debt in the economy? It's true. There is a lot of debt. The government owes a lot of money. We're at a very high percentage of GDP, but what matters is our ability to sustain the debt. So usually companies don't go bankrupt and you actually get hyperinflation, which, you know, the Ponzi of paper money will evaporate at some point for every country. But the question is really, is it something we have to worry about now? And the pro says, well, what is our capacity for actually paying this debt? And that answer is right here on this chart. Back in the mid 80s and the early 90s, between the 80, 82, and the 91 recession, during those 3 recessions, our outlay, or a percentage of GDP that went towards interest, was actually substantially higher than where we sit today, which means the capacity for us to keep paying this debt and keep the sort of Ponzi going is actually really high. So yes, the debt is a problem. And yes, that is leaving the 10-year treasury yield elevated right now. But it's not actually what will lead this economy to collapse in the near term. There are other issues. And small businesses are a leading indicator that we might be trending towards recession. Small business employment is falling. SMEs, small medium enterprises, are usually a leading indicator that, hey, there are real problems in the economy. But there's a flip side to this, that if we look at what's going on in Canada, Canada's basically had this recessionary 2-year period, especially with a housing crisis that they've had. They don't have the benefit of a 30-year fixed rate mortgage in Canada. But you've had a lot more of a challenge for Canada to deal with even Trump's tariffs. But look at what's happened recently. If you look at the last 5 months of jobs data in Canada, it's actually started to form a Nike swoosh recovery. Now, some people say, oh, but Kevin, that's just government jobs data. And when we charted it, we actually saw a decline in government jobs while we've seen this increasing growth rate, these right here, growth rates, in total jobs in Canada. So I'm not here to profess that I know everything about the Canadian economy, but what I am here to say is that if the US economy can stick a Nike swoosh recovery in the labor market, we could actually go for bullish catalyst for the United States. But that's the only thing that makes me bullish on the US economy, is that we can Nike swoosh a labor market recovery. See, a lot of people say, Kevin, we should be bullish because of deregulation coming. The problem with deregulation is it takes a very long time. See, that's where I also like to say, the noob says, but Kevin, they're going to deregulate. You know, they're going to cut for every one regulation that Trump creates, they're going to cut 4 other regulations. That's great and fantastic marketing. But the pro knows there's a massive lag between when you get regulation cuts and when you get benefits from those regulation cuts. I like to think about it in reverse. The benefits of how strong our economy is today overall, I don't want to say the economy is like perfect today, but why the economy's been so resilient. You know, we have issues, okay? I'm not blind to the issues we have right now, the K-shaped recovery, you know this. This is all old news. We already know that. But one of the reasons we've been so resilient after 2021 and 2 and 3 and 4 is because we've actually been propped up on, you know, a relatively strong set of regulations that have made companies more transparent to their customers, fewer scams and fewer frauds. When you remove regulation, you can actually create a bubble that takes years to form, and some of the components of those bubbles are fraud, and it takes years for those to actually fall. So Pro knows that deregulation is a delayed bullish catalyst. The other bullish catalyst that people are really excited about is that, oh, well, the Fed will just keep cutting rates. Maybe that's a foregone conclusion. The noob's like, oh, but the Fed's cutting rates. The pro looks at that and says, bro, well, what's 25 bips here or there going to do to actually support this economy? Not much. So near-term regulation cuts doesn't really help us. Near-term 25 basis point cuts doesn't really help us. It's too slow. And if we fall off a cliff because the labor market collapses on these catalysts that are coming up, then that's also really bad. So all of those that appear to be bullish are actually bearish. And that's why I say the best thing, hands down the best catalyst that could happen for us, is that we pull a Canada with our jobs market. Is that the November and December job numbers, and even going into January, so the job numbers that we're going to get the first week of February, so February 6th, these next 3 jobs reports, if we could pull off bullish catalysts on those and actually not fall off a cliff and not see layoffs skyrocket, best case scenario for our recovery. Now look at T.S. Lombard. T.S. Lombard tells us that right here, we're sitting at a recessionary level of the hiring rate. But in addition to this recessionary hiring rate, we're at boom time layoffs. In other words, layoffs haven't ticked up. Well, this is old news. We already know this. But the pro also comes in and says, hey, wait a second. If this is true, then what happens when all of a sudden we switch and layoffs spike? Well, that's when you get instant recession, right? We know that. That's old news. Okay, fine. So what are the catalysts that could be bearish? Well, the biggest negative catalyst for this market, in my opinion, is Sam Altman. Sam Altman is the biggest negative for everything that we're facing right now. Why? Because I kind of think he's sort of like the leg. It's not the straw that breaks the camel's back. I kind of see Sam Altman as the legs of the actual camel. That is the only thing really propping things up right now. See, if Sam Altman rugs his $1.4 trillion of AI data center spending, then AI forecasts for spending on NVIDIA chips plummet in Q2. And then that leads to a reduction in investments for OpenAI, which means less chip sales for AMD in Q3. So then data centers get hit, which is somewhat already hedged, but then private credit gets hit. And if you align that with stalling or falling stocks, the Japanese carry trade issue unwinds even faster. It all comes together in a bad way. So it's not to be broadly bearish. It's just to say you need Sam Altman not to die, basically, for OpenAI to fall, because that would be bad, because those are all the spending commitments that are propping up the economy. And you want the labor market staying propped up, while at the same time we're like, man, is the Fed going to rug pull us, or are they going to print money? Well, they can't print money until things fall off a cliff. And if things fall off a cliff, it's too late. Then the Fed proves they're too late. So you're really in this crappy space where we're hoping the Fed doesn't hawk too much, but why are we seeing stocks sort of vacillate right now? Well, it's because of the nervousness that, hey, we got a powie wowie and a potential owie this Wednesday. It's obvious. So hopefully we get, we're expecting a cut on Wednesday. We're then hoping that Powell doesn't hawk, and instead he just says, let's focus on the data. We've got a lot of data coming up before the January 28th meeting. And that's the window that I think the real pros are looking at. The real professionals are saying, look, between December 16th and January 13th, we're going to get 2 jobs reports and 2 CPI reports. If we don't fall off a cliff there, hopefully we can stick the soft landing. And yes, we're going to see through some tariff inflation. It's only so long before Trump tariffs hit consumers. We already know that. We've known that inflation from tariffs was going to show up about 6 to 12 months after liberation, because companies stock up on inventory. And then once they run through that inventory, they have to acquire new product at higher costs. And when you acquire new product at higher costs, you're going to have to pass on some of those costs to the extent that you can. And if you can't, your pricing power goes down, your stock goes down. If you can, then consumers face higher costs. Both are bad. So either EPS goes down or consumers face higher costs, and we see it show up in consumer inflation. Both of those aren't good for the stock market, but we want to see our way through that. We want to see that limited. And the best time to see that is this next 5-week period of time. So we're coming into 5 weeks that matter. The last 8 weeks, less so. Way fewer catalysts. Now, at the same time, Donald Trump is pumping stimulus. Donald Trump is pushing for $12 billion of a farmer bailout that's robbing the emergency fund over at the USDA to bail out farmers who have been hurt by the soybean disaster with China, but then also just broadly tariffs on machinery, which isn't great for farmers. At the same time, the Saudis in this filing are partnering with Jared Kushner to try to bankroll Paramount's acquisition of Warner Brothers to fight Netflix buying Warner Brothers. So it always seems to show that the Trump administration's family has their hands in a lot of what's going on, even in the Paramount Warner Brothers deal. I mean, it even goes as far as Carolyn Levitt's apparently nephew getting being involved in getting bailed out of prison. Look at this. Levitt's brother, Michael, gets bonded out at the lowest possible bond after the Trump administration says that the individual who got bonded out at the lowest possible level, the actual government is like, oh, this is a criminal. They've got a criminal record. They got arrested by ICE on the way to drop off their kid at school. They're going to get deported. And then that flips and turns around with, oh, no, that's actually unfair and untrue, says the Trump administration. That's not true. This is rigged. It's just kind of interesting because it shows that a lot of this economy is a friends and family game. And so Donald Trump, going back to econ, where we want to be focused on, Donald Trump has a lot of incentives to keep Sam Altman propped up. Because if Sam Altman doesn't stay propped up, which is why he's asking for government backstops, then the whole sort of moving camel could collapse. So you actually do want to watch the friends and family moves of the Trump administration, because they are the very things that could temporarily keep things propped up longer. Again, Sam Altman falls, the whole thing collapses. There was a piece in the Wall Street Journal this morning yapping about the depreciation schedules again, by the way. I want to note that, what pros do when it comes to this talk about depreciation is we look at, hey, well, what are the actual depreciation curves? And there is literally a 2017 NVIDIA V100 chip that is still getting rented out for 55 cents per GPU hour. That's incredible. So you have an incredible money producer still on a chip that is 8 years old. This has comparable performance to like 3060 chips, the consumer grade 3060 chips. It's insane. Oh, look at this. Literally just now, US to allow NVIDIA H200 chip exports to China. Literally just now, breaking news. I'm telling you, everything right now is propped up by the Trump friends and family benefits. So that should shoot NVIDIA up right now. Yeah, fat green candlestick right here on NVIDIA. Now, whether or not China actually buys them is, not necessarily a foregone conclusion. Now, you look at some of the other reports that are going on in terms of our retail investors, for example. The BIS has a whole piece on how the S&P 500 and gold are at risk of being in a bubble because of retail. Basically, how much retail buying there has been for artificial intelligence and gold, and really this trend chasing. But they at least acknowledge that it's hard to say that this trend chasing definitely puts us into a bubble. While it's definitely speculative, we don't really know when there's a bubble. And that's kind of a funny acknowledgement. So the the Bank of International Settlement put the study out, and they're like, hey, we don't have any tools for actually identifying when we're really in a bubble. So this is why I say, bottom line, as long as we can keep jobs ideally doing a Canada or stabilizing over the next 6 weeks, we're good. We shouldn't have to be worried about this pop. Now, if the AI bubble pops, that's when we have a problem. It's the AI bubble of Sam Altman rugging 1.4 trillion, leads to the private credit falling, leads to stocks falling. Stocks fall for more than a dip. Retail runs out of money. Leverage blows up. Japanese carry trade blows up. That's exactly why I sit midpoint on the bear bull scale right now, or the bull bear scale. It's probably the better way to put it. I'm midpoint. I'm a 5. Right there in the middle. Because there are so many things that can go right, but that labor market is the one thing to watch for. So this is where, when we look at yields right now, 4.18, this sucks on the 10-year treasury. It's anti-stimulative, mind you. And it's no surprise that we're at shock level at a 59 on the 10-2 spread. But the real question comes down to these next catalysts. So expect nervousness over the next 5 weeks, and the data will be everything. I would argue that with a survey of 40,000 jobs right now on the next labor report coming out next week, as long as we get something that's positive, we're probably good. Sounds crazy to say, but break evens for the labor market are probably plus or minus 0 right now because of the deportation movement that we've seen. That means as long as we have positive data, even though it's a big downtrend from what we've seen at the beginning of the year, labor markets could still be okay, and actually gives you sort of a floor to ramp up off of. And so I'm optimistic we could pull a Canada here. And that makes me really excited. That gives me bullish catalyst. Means you've got some time left to pick up, in my opinion, things like real estate, because it'll take a little longer for those yields to really fall. And yields come down one of two ways. One, very quickly, because you go into a recession, yields come down, which is supportive to real estate. Or slowly. I don't mind slow because it means the economy's holding up and you still get that slow trend down in yields. But it's going to take a while. It's going to take some real time. So anyway, somebody here writes, NVIDIA, yeah, exactly. So again, this is on the H200. Now keep in mind that NVIDIA has argued that we may not actually see China buying our chips. And so that is a risk factor because China is trying to diversify away from American chips. So that's a near-term risk factor. Initially people are going to go, oh my gosh, this is great. Let's write up NVIDIA's earnings. Fair. But be careful, because if China doesn't buy any, then it's sort of like, wait a minute. Okay, now they're trying to really ice us and prop up their own chips, whether they're Alibaba's chips or, whatever. I mean, they've all probably stolen IP from NVIDIA anyway. But I think it's a really good consolidation of where we stand right now. The positive catalysts of deregulation or this AI boom or whatever carry real risks for next year. We need to V-shaped recovery. We need to Nike swoosh like Canada. I'm optimistic we can pull it off. But until then, I sit in the middle and I go, you know what? I'll buy stocks and I'll go snipe what are good values in stocks, as we've been doing in the Alpha Report. Make sure you get that over at meetkevin.com. But I'm certainly not going to leverage up for it. Anyway, that gives you my summary of what the hell is going on in this market. Thanks so much for watching, and we'll see you in the next one.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.